This is the only video you will need to start trading in 2025 as a complete beginner. In this video, we're going over what trading is, how to read candlesticks, the tools that you will need, and my simple supply and demand strategy that I use personally to make consistent profits in the markets. So what's trading? Trading is all about buying or selling financial assets for a profit. And there are many different asset classes that you can trade. You can, for example, trade in the stock markets where you buy or sell different stocks. You can also trade in the commodity markets where you buy or sell gold and platinum and all these different commodities. And you can also trade, for example, in the forex market. So let's take forex for example. Everyone watching has traded forex before. If you, for example, go on vacation from Europe to America, you will need to exchange euros to dollars, and when you do that, you have traded forex, my friend. And in trading, it doesn't matter whether the markets go up or goes down. You can make money either way. So let's say you buy an Apple stock at $50 and it goes up to $60. That means that you have profited the $10 difference. But we can also make money when we are betting that the markets will go down. That's called shorting or selling. So shorting basically means when you borrow an asset and sell it at a high price and buying it back lower at a lower price. So let's take the Apple example again. If you sell Apple at $60 and the price goes down to $40 and you buy it back again at $40, that means you have just profited the $20 difference. So let's get into the charts. Now, the first tool that we will need to use to analyze our trades is called tradingview.com. And don't worry, TradingView is free to use. You just have to create an account and you are ready to go. So when you go on TradingView, you will see all these different asset classes that you can trade. So you can trade indices, stocks, crypto, and many more. So let's say, for example, that you want to trade the forex market and more specifically the euro against the US dollar. Then you will go to the search bar and you will type in the euro against the US dollar. And what you will see now is all these different brokers providing the euro against the US dollar. I personally always use Owanda because I think it's the most easy to read. So then if you want to open the euro US dollar chart, you will click on launch chart. So when you launch the chart of the euro US dollar, you will see this chart right here. A chart is just basically price movements over time. And on the x-axis we can see the time, and on the y-axis we can see the price of the specific asset we are looking at. A chart is just made up of individual candlesticks, and each of these candlesticks represents a different time frame. And on the left top corner right here, we can see that we are looking at the daily candlesticks. So each of these candlesticks represents a daily price movement. So if the candlestick is green, that means that price went up that day, and if the candlestick is red, that means that the price went down that day. And so we can select different time frames. So if you click on the 4-hour now, every candlestick is now a 4-hour price movement. And we can also look at the weekly. So now everything is a weekly price movement, and you can even click on the lower time frames like the 1 hour or even the 1 second. To better understand how these candlesticks are formed, I will do a quick breakdown. So every candlestick is made up of 3 parts. We have the body of the candlestick, the high and the low, also called the lower wick and the higher wick. If price opens lower than it closes, that means that price went up that day. And if the price opens higher than it closes, that means that price went down on that specific day. And if you have paid attention, you will have seen that some candlesticks have bigger bodies and smaller wicks, or some have bigger wicks and smaller bodies. These different candlesticks are called candlestick formations. Now what does these formations mean? So if the body of the candlestick is more than 70% of the whole range of the candlestick, this means that the candlestick is decisive or explosive. And an explosive candle means that there is an imbalance between buyers and sellers. And in this case, if it's green, that means that the buyers are in control of the market. And if you look at the other one, if it's a red candle, that means that the sellers are in control. And if the body of the candlestick is less than 50% of the whole candlestick range, that means that this is an indecisive candle. An indecisive candle just simply means that the buyers and sellers are in balance, so no one is in control. So now that you have a good understanding on how to read the charts and how the different candlestick formations are formed, we can go into my supply and demand strategy that made me personally a funded trader and a consistent profitable one. So why do I trade supply and demand? Supply and demand is the basic economical factor that drives prices. We all learned this in school, guys. If there is more supply than demand, the prices will go down. If there is more demand than supply, the prices will go up. So there's no need to use all these fancy indicators. If you just master supply and demand, you will be ahead more than 90% of traders. So let's start with identifying these supply and demand formations, beginning with demand formations. Supply and demand formations are always formed in three phases. In this specific demand formation, there is a big bullish candle where the buyers take over, followed by indecisive candles where there is balance, and then again followed by a big bullish explosive candle where they take control over of the market again. The second demand formations exist when the sellers take over with the big explosive candle, followed by an indecisive candles where there is balance, and then again followed by a big explosive candle where buyers take over again. So now that we have identified these point of imbalances, we can highlight these levels like this. And the next time that price comes back into these levels, we can expect a reaction from that demand levels and we can go long. So let's start with the supply formations. Just like the demand formations, it's also formed in three phases. In the first phase right here, we can see that the buyers take over with a big bullish candle, followed by an indecisive candles, and in the last phase we see that the sellers take over with an explosive candlestick. In the second supply formation, you can see that in the first phase the sellers take over sharply with the explosive candlestick, and in phase 2 we see that there is indecision or balance, and in the third phase the sellers take over again with this big explosive candlestick. And now, just like the demand formations, you can also highlight these levels just like this. And the next time that price comes back into these supply levels, we can anticipate a short from these levels. And the most important rule in these supply and demand formations is that in the third phase of these formations, the candlestick has to be an explosive candle with a body more than 70% of the total range of the candlestick. Otherwise, it won't qualify as a good supply or demand level. So now we know that supply and demand moves prices. We can go into the charts to identify these key levels where price will most likely react from. So let's get into the charts, and we are going to start with identifying the two different demand levels. And as I'm looking at the chart right here, I'm seeing this formation right here. And here we can see that the sellers take over first, followed by a balance, and then the buyers take over with this big explosive candle right here. So now we can highlight the point of imbalance with our rectangle tool right here. And we can highlight the indecisive candles like this. And then the next time that price comes back into this demand level, we can expect price to have a reaction. So the chart went up, down, a bit sideways, it went up again, and then it went down into our demand level and it reacted from there. The second type of demand that we'll be looking for is a place on the chart where the buyers take over, followed by a base, and then the buyers have to take over again. And as I'm scrolling through the chart right here, I'm seeing this demand level right here. As we can see, the buyers took over, followed by a small base, and then they took over again with this big bullish candle. So now we do the same thing as we did earlier. We're gonna take our rectangle tool, and the next time that price comes back again in this demand level again, it had a beautiful reaction. So now we have identified the two demand levels. We're going to look for the two supply formations. And as I'm looking here again, I have found something here, right here. You can see that the buyers took over, followed by a base, and followed by a big bearish candle where the sellers took over again. So we do the same thing as we did earlier. We're gonna highlight the point of imbalance, and the next time that price comes back into this level, we expect a reaction to go short, and the price went down. It came into our zone again and it reacted beautifully. Let's look now for the second supply formation. And as I'm looking here again, I've already found the next supply formation. Here, the sellers took over, followed by a base, and the sellers took over again with this big explosive candlestick. We do the same thing as always. We're gonna take the tool, we're gonna drag it into the future, and the next time that price came into this level again, it had a beautiful reaction again. So these supply and demand patterns happen everywhere on the chart, on every time frame. You have to train your eyes to see these levels. Take these supply and demand trades. The way I would do this is I would find the built-in trading view indicator called long or short position, and then I would take the long position for demand levels and I will put the entry right on the first line of the rectangle, and I will put the stop loss right beneath the rectangle, and I would target a 1-to-1 or a 1-to-2 profit target. So these profit targets mean, for example, if you risk $1,000, a 1-to-2 means that you risk $1,000 to gain $2,000, and if you aim for a 1-to-1 target, that means that you risk $1,000 to gain $1,000. Now, after I have done my analysis and I know where my stop loss and my take profit target is, I would calculate my lot size to risk $1,000, and then I would execute this trade through my broker using MetaTrader 5. That was the video, guys. You now have all the information to start trading. If there are any more questions, shoot them down below and I'll be happy to answer them.